Most Australians believe owning property is the safest path to wealth. But what if I told you that for some investors with large investment property debt, selling the properties, renting instead, and investing the proceeds could actually improve cash flow and potentially build more wealth? Today, we're comparing property investing with large liabilities versus rent vesting and investing in shares. And I'll show you a real life style example that makes the numbers easy to understand. Let's look at a common scenario. Meet John and Sarah. They're in their early 60s. They own a family home, 2 investment properties. The investment properties are worth $2 million combined. However, they still owe $1.2 million in loans. Their properties are generating rent, but they're also dealing with interest costs, maintenance, council rates, insurance, property management fees, vacancy risks. On paper, they look wealthy, but their cash flow feels tight. Let's assume property value, $2 million. Mortgage, $1.2 million. Rental income, $80,000 annually. Expenses, interest, $72,000. Rates and insurance, $8,000. Maintenance, $5,000. Management fees, $4,000. Total expenses, $89,000. Annual cash flow, negative $9,000. In this example, the investor is actually contributing money every year just to hold the properties. Now let's explore another option. Suppose John and Sarah sell both investment properties. Sale proceeds, $2 million. Less loans, $1.2 million. Remaining equity, $800,000. After selling costs and taxes, let's assume they have approximately $700,000 available to invest. They decide to rent a home, invest the $700,000 into a diversified portfolio. Let's assume a 6% annual return. That generates approximately $42,000 per year. Notice something important. The property strategy relies heavily on future capital growth. The rent and invest strategy focuses on simplicity, liquidity, reduced stress, improved cash flow. Neither option is automatically better. The right choice depends on your goals. Many investors underestimate several risks. First, interest rate risk. A small increase in rates can dramatically impact cash flow. Second, concentration risk. Having most of your wealth tied to 2 properties in one market can be risky. Third, liquidity risk. Selling part of a property isn't easy, but you can sell small portions of a share portfolio whenever needed. Property can still outperform, particularly when property prices grow strongly. Debt levels are manageable. Rental yields improve. Tax benefits are significant. In some situations, holding quality property can create substantial long-term wealth. The key lesson isn't that property's bad. The lesson is this. As you approach retirement, it's worth asking, is my property portfolio helping my lifestyle? Or am I simply carrying debt and hoping for future growth? For many Australians, reviewing the numbers objectively can reveal opportunities to improve cash flow, reduce stress, and create greater financial flexibility. Every situation is different, so always seek professional, financial, and tax advice before making major decisions. If you'd like more Australian retirement, superannuation, tax and investment strategies explained simply, subscribe to the channel and hit the notification bell, and let me know in the comments, would you rather own investment properties or rent and invest in shares?